Hi, we're doing market beta and returns. I'm Dan Roach.
I'm Bailey Mitchell.
I'm Jonathan Hom.
And I'm Bailey Hannah. So this is kind of our table of contents. This is an overview of what we'll be going over today, and we'll first start out with the executive summary. So this here is the executive summary for our project. The goal of this project is to analyze how helpful beta is when predicting stocks, and we use the U.S. stock market for our study. To come to our conclusion, we will be using hypothesis testing. Here's a summary of kind of what we'll present today, starting with our business question, and then we will be following up with that by measures, models, and data from the Yahoo Finance. And we use that to come to our conclusion. Our conclusion will culminate with our findings and a comparison with Clayton's group's findings as well.
Being in the Tippy College of Business, we discuss all things finance. This includes the stock market and indicators used in the stock market regarding investment decisions. One of those indicators is beta. Beta measures volatility relative to a benchmark for the market, traditionally the S&P 500. Beta is commonly used as a proxy for the risk for the individual markets. Higher betas are usually associated with higher risk, and higher risk is associated with higher return. Therefore, we assume greater betas would be associated with greater returns. We wanted to learn whether returns of high beta stocks are, in fact, greater than returns of low beta stocks. And we looked at the market as a whole. By defining why we wanted to dive into the relationship between beta and returns, we were able to approach the relationship feeling more confident knowing what we wanted to learn. Our problem statement is our returns of high beta stocks greater than returns of low beta stocks for the entire market. As our hypothesis is our returns of high beta stocks greater than returns of low beta stocks for the entire market, we also wanted to find out if higher risk is significantly associated with higher returns, and if the difference in volatility between high and low beta stocks is enough to yield significant returns. Our measures are stock betas and average returns, which are both numerical.
For our analysis, we made the following assumptions. The list of stocks produced from the random stock generator were truly random and publicly traded companies within the U.S., excluding mutual funds, ETFs, leveraged funds, among other things. The reason we excluded these stocks was because they are not companies, but usually a pool of stocks that relies on its portfolio's performance to increase or decrease the stock price. Looking at the market as a whole avoids our results from being skewed by a sector that has traditionally high or low beta. By defining our analytical questions and assumptions, we were able to structure our test in such a way to ensure we get answers from what we learn about. We used a random stock generator like this one to randomly pick 100 stocks excluding mutual funds, ETFs, and leveraged funds, among other things, and only used publicly traded companies. We retrieved our data for 100 stocks from Yahoo Finance. Yahoo Finance records all listed stocks for the entire market. For each stock, Yahoo Finance publishes a 3-year monthly data, which we use. We then downloaded the past 3 years monthly historical data for stock prices from Yahoo Finance and calculated the average monthly percent return for each stock. The calculated average monthly percent return is what we use to measure returns for the stock.
Hello, my name is Khalil Dowd. I'm the 5th member of this group, and I was doing the camera work beforehand. Hopping into methodology, there's 2 available methods for us to use. We can do either regression analysis or hypothesis testing. And our group determined that for the best fit for our project, we decided to use an unpaired 2-sample t-test. We came to this decision because we were looking at 2 different test subjects, in this case the top 10 highest betas and the top 10 lowest betas out of our sample group. Using an unpaired 2-sample t-test is also great for us because it has an equality of outcomes, meaning the variance on both ends is the same because we chose the top 10 and the top 10, and the top 10 lowest as well. We decided a regression analysis method was not going to be good for us because it's extremely sensitive to outliers. It's very common for stocks to be uncharacteristically high or low in their betas, as well as the betas not being fully representative of the company's average return. Also, beta itself is actually a regression analysis ran within the stock, usually compared to a benchmark such as the S&P 500. So if we were going to do a regression analysis, it would essentially just be proving the math behind the beta, in which case it would be useless for us to test. After we gathered our data and figured out our methodology, we went straight to our model. From here, we pulled 100 random stocks from a random stock generator online, which pulls from NASDAQ listed companies as well as New York Stock Exchange listed companies, all US exchange companies, as that was one of our criteria to make sure we had equality within data. And then from there, we pulled the top 10 lowest and the top 10 highest betas for the entire sample, in which case lowest ended up being mostly negative beta stocks, which is perfectly fine as it does count for a low beta. From there, we obtained each company's 3-year monthly returns, as that was in line with what our beta was, found the average for that, and then averaged each individual one to get a total average for our low beta as well as our high beta. After that, we went to make sure I calculated our mean and our standard deviation for each one, and we could assume an unequal variance between the two because of the differences between the standard deviation in the sample low beta as well as sample high beta. And from there, we ran our hypothesis test, plugging our data into a t-statistic equation and the degrees of freedom equation, which Dan will now go over inside of our conclusion to find out what we found.
Hi, I'm Dan Roach, and we'll be going over the conclusion of our project. So we found that for the top 10 high betas, their average return was 1.83% compared to the top 10 low betas, which was negative 1.51%. What does this mean? Well, this means that the average returns of the 10 highest betas is greater than the average return of the 10 lowest betas. With a p-value of 0.02 compared to our alpha of 0.05, we can reject our null hypothesis that high betas have a lower average return than low betas. This proves our alternative hypothesis that high betas do in fact have a higher average return than low betas.
So our findings were actually in contrast to another group from Clayton Weyrather, Tyler Dennis, and Matt Lindsay, where they used industrial sector stocks to test essentially the same thing. So they found a random sample of 100 industrial stocks from the top 10 lowest and highest betas, and found that their lowest betas actually had a better overall return than their highest betas. This is due to a few things, in our opinion, is that they had a different null hypothesis, and they was that low beta stocks actually returned higher than high beta stocks, as well as a few things that the industrial market has compared to the overall market. Industrial markets in history are very cyclical, and because of this, it might have been caught in a mid-cycle or a peak or a trough within that cycle, which could have caused the low beta stocks to return possibly better as they're not as variant compared to the overall market, as well as the fact that industrial companies also have to have a lot of capital spending put in, which does overall affect their price in the case there were startups or fresh IPOs within that industry.
All right, so some weaknesses or limitations to us would be our sample size and when our data was extracted. So our sample size was 100 stocks. On the New York Stock Exchange at any one time, there's over 2,800 stocks listed, and then 4,000 in the market overall in the US. This grows larger with the global markets and all this stuff. So there's a lot of stocks there that we could have picked from, and 100 stock as our sample size may not be indicative of the market as a whole. Another limitation or weakness we might have come across was that the fact that we pulled our data from mid-November, and there could be things affecting our stocks in mid-November that wouldn't affect it in another month, say May. Things like Black Friday, which obviously affect retail sales or retail stocks more because they're going to get that influx of sales, which may increase or decrease their stock price and affect their beta. There could be the run-up to Christmas. There could be the recent Q3 reports, quarterly earning reports from the tech sector, which have a great impact on the S&P 500 and betas overall because the tech leads the market in terms of pricing and betas. However, for the sample size, 100 stocks, if we had just picked, let's say we did 2,800, we did the whole stock at New York Stock Exchange, we picked all of them. Our top 10 high betas and our top 10 low betas could be from one or two sectors and not representative of all sectors. So let's say we did our top 10 high betas from the entire New York Stock Exchange. Well, they could all be from the tech sector because the tech sector is who leads the market and it dictates the pricing for a lot of stocks and the betas of a lot of stocks. So we could have, theoretically, top 10 high betas all from the same market or sector and top or low betas from all the same market or sector. And this would really not indicate for the other sectors in the New York Stock Exchange. It would really only be indicative of those two sectors and would not include the entire market. Another thing about pulling our data from mid-November, there's always things that affect stocks. It's the stock market. They react to current events. So what wasn't going to affect the stock market in mid-November, there could be things that could affect it in May, such as summer sales, another sector's quarterly reports. There's always outside influences on the stock market because that's what drives stock market prices, is outside events and demand. So just by getting rid of mid-November events, we'd just be introducing other months' current events, things that happened during that time. In conclusion, we found that high betas do have a higher average return than low betas in our given market period. Thank you for listening. Go Wallabies and go Hawkeyes.